Hey everyone, and welcome to the channel. I want to share with you today how to actually pay off your credit cards fast. Now, I'm going to share with you a secret that credit card companies don't really want you to know, and in doing so, you might be really encouraged to get those things out of the way as quickly as possible. So I think today's content is going to be really useful for you, so make sure you stick throughout the whole video so you can get all this information and really be able to take charge of your financial future. Now, in case you don't know who I am, my name is Dennis, and here on this channel, we love to talk about ways to make money, invest money, and save money, just like in today's video here. And make sure you hit that subscribe button down below, and let's go ahead and get started with this topic today. Now, of course, we're going to be talking about credit cards today, and the first thing we want to talk about is revolving debt. Credit cards don't have a set payoff date, so they're considered revolving debt. Similar to Buddy the Elf going around in circles here, this kind of debt doesn't have any end date for it. It just keeps going around and around, and this is probably one of the most favorable ways credit card companies are able to obtain customers is through revolving debt. Now, to give you some context, home and cars are term debt, so they actually have set dates for when the loan is paid off. And they actually are an asset, which means that there is something backing up that loan. For a quick example, if you have a $20,000 vehicle and you have a $25,000 loan, at least the bank has something to take from you if you for some reason didn't actually pay on those debts, where the credit cards actually don't have anything backing them, which is why credit cards actually have a high interest. Because credit cards are revolving debt and again have no asset behind them, you are going to be charged a much higher interest rate, anywhere from 13% to 28% and more when it comes to the fees on that credit card. So really pay close attention into this next slide, because I think this is really important for people to kind of keep in mind when it comes to utilizing credit cards, and that is interest is the penalty that you pay for the opportunity to buy something in advance. And I wrote on here to actually read this again, and not just for me, but for you and yourself if you are watching this. And again, that is interest is the penalty that you pay for the opportunity to buy something in advance. You have the ability to save money for things that you want in your future, but a lot of us don't take the time to save up for it. We just put it on a credit card and pay for it later. And believe me, you're gonna see here today, you are definitely going to pay for it later. And the main reason I wanted to make this video is so we can see how much of this opportunity are we actually losing, and you're probably going to be surprised. So I got some statistics here to help kind of go through this process. So as of 2019, the average American adult has a balance of $5,839 on their credit cards. Now, just for a little bit of context, the average household has $8,398. And if you want to get more detailed information, you can head over to creditcard.com, where I got some of this information to be able to provide this here for you today. Now, I do want you to keep in mind that this is only consumer debt on credit cards. Homes, cars, personal loans, and other debts are not included in this total that I just gave you. And I really appreciate this head blowing off emoji to really emphasize my mind being exploded, that is just on credit cards, and what people are going to be paying over time is going to be even crazier, and we're going to get into that here in just a little bit. Now, let's look at the average interest rate on a credit card, because this will also play a factor in our math that we're going to be doing today. Now, I've mentioned that interest rates can range from 13% to 28+%, and the average cash back credit card has an interest rate of 20.9% as of 2019. I kind of wanted to make sure I mentioned cashback cards because there are so many other types of cards, but cashback cards seem to be the most popular ones, so I definitely went with that option. And I got this information from valuepenguin.com if you want to check out more information from what I was able to gather. Now, how much interest is calculated on a credit card? Now, to be 100% honest with you, until I made this video, I actually didn't know how my credit card was actually being charged every single month. Now, for me personally, I don't have a balance on my credit card. I actually don't even wait till the end of the month to pay them off. I just pay them off as I charge, just so I can earn my bonus points. But that is beyond this video. But what we're going to be talking a little bit more about is understanding that actually most credit card companies compound their interest daily, but you can actually find out how your issuer charges you by checking your account and looking under pricing information, sometimes also called the Schumer box. Look for a line that's called how we calculate your balance. And to give you a really good idea of what it can look like, I have a little photo here in the bottom left hand corner of this slide, so you can kind of see potentially what it would look like on your statement or in your agreement document. now that we know the averages, let's do some math and calculate how much it will actually cost you to have this credit card balance. Yay, math. We are so excited to continue. I bet you are as well, but luckily for you, I'm gonna go ahead and do the majority of the work, and you're just gonna be able to see exactly how much it's gonna cost to have this type of balance on your card. Now, warning, you might actually feel sick after seeing this. There's not gonna be any graphical images or anything violent, of course, but you might be really shocked at the end results when I go over these numbers. Now, we talked about earlier the average balance of $5,839. Yours might be higher, yours might be lower, but we're just going to kind of go with this example so we can kind of get a really good idea. Now, we're going to go pretty much close to the average of interest, which is the 20.9, but we're actually going to just do 20% for a little bit easier math here today. Now, the minimum for this card would be about $155.71. So keep in mind that every company calculates their minimums differently as well. So not only do they calculate how their interest is charged on your card differently than other companies, your minimums might also be completely different as well. So let's break down this minimum payment from the example. And before we continue, make sure that you gently tap that like button down below if you are getting some value from this video today. And at the end of this video, if you got so much value and you feel encouraged to pay off your debt, I want you to potentially share this out with somebody else that can really get a lot of value out of this video and maybe change their life too, to encourage them to go through the process of managing their finances just that much better. Now, we're going to go back into our example here today, and we talked about earlier the minimum balance, which is $155.71. Now, I actually went through and looked at how my minimum is charged on my credit card if I were to have a balance. Now, on my credit card, it is interest plus 1% of the balance. Every credit card is different, so yours might not be the same as mine. So let's go ahead and see how your very first payment is going to be charged from this balance. Now, we're going to go in this example with a mindset that we're not going to be adding any more debt, and we're just going to be paying the minimum on this balance. So the first portion of your payment is actually going to be charged for your interest, and that's going to be $97.32. And then the other portion of the actual payment is going to be going towards the principal or the original balance at $58.39. So what this means is out of $155.71 that you are going to send to the credit card company, $97.32 of that is fees, which essentially is the interest and everything that's going to be accumulating over time, and that you're only going to have $58.39 that is actually going to have an impact on your balance. Now, this is really clever for credit card companies because for you, $155.71 out of $5,000 seems like a smoking deal for somebody not having to pay the full balance all at once, but all the underlying information, all the stats, all the interest and the minimums and all these different things that make it look appealing for the minimum is going to cost you a ton of money in the long run, and we're going to find out exactly how much that's going to be. Now, before we show you how much that's going to be, I want to show you an amortization chart. Now, if you're not too familiar with these, this essentially is a breakdown of how your payment schedule is going to go if you don't pay anything extra or add any additional debt. You saw the first month of the breakdown, the $97 and the $58, and you can see by month 12, you're going to have a minimum payment of $139.41 and how the interest and the principal is split. And of course, you have the 12 months here, but you also are going to have additional money that you're going to have to pay for another 281 more months of payments. That's an unbelievable amount of time that you're going to have to pay on this credit card if you just pay the minimum. And for those of you out there that are wondering, well, how many years is that? That's 24 and a half years of paying the minimum payment on this card. Now, I know there's some of you out there that may be saying, well, Dennis, I don't pay just the minimums. I pay, of course, a little bit more, so that way I'm not going to be stuck with that full balance for that amount of time, but it's still going to be really shocking on how much interest you're going to pay in the long run. So without getting too far into adding extra into your actual payments and doing anything extra, I just want to go based off of the minimums because there's a lot of people that just, again, pay the minimums. And in that time, you'll pay interest to the amount of, wait for it, thank you, Barney Stinson, $9,121.58 just in interest, not including the balance. That is a lot of money to be paying, especially over the course of 24 and a half years. So let's go ahead and add this all together and see where we're standing. So we had the original balance of $5,839. We added the $9,121 in interest. You're going to be paying a whopping $14,960.58 in total. So I really hope whatever you put on that card was worth 1.6 times what you originally paid. That means for every $100 that you had to pay in to buy something, you're going to get charged $160 to be able to own that item, that service, whatever it is that you put on that card, and only paid the minimums for. Now keep in mind that this is the amount that you will pay if you only ever pay the minimum and also not add any more debt. Because if you're adding more debt and still only paying the minimums, that revolving debt is just going to go higher and higher. Some people do pay more, of course, like we talked about, and that will really help you out. But I really wanted to show the impact of having a balance on your card. Now, credit card companies love when you only pay the minimum. This is their secret. They want people to just pay the minimums because they're going to have a customer for life at that point. They're always going to be there for you, and you're always going to be at the mercy of paying them every single month, because as you build a bigger balance, your minimum will go up, but not feel like it's a huge impact on your life, so you'll continue to pay that amount. Now, there's also a thing called opportunity costs, and I really want to break this down because when it comes to having money on a credit card, some people are okay with paying a little bit of interest when it comes to spending their money. And if that's your prerogative, totally fine. But I want to also share with you that because you are now paying 1.6 times the cost of the items that you are buying, you don't have that money to invest in things that will potentially make you money in the future, whether that is in the actual stock market, whether that's in houses, whether that's in yourself. If you're investing in yourself, you can potentially move forward in actually being able to earn a bigger income. When you're putting money towards credit cards and having credit card debt revolving all the time, you're not going to have opportunities for yourself. And so you're actually putting yourself not just in the original hole of paying the interest, but then also the opportunity that you could have had by spending that money on things that actually can make you more money. So now you might be thinking, well, what are my options when it comes to finding out about this information and taking some action? Now, the first action you can take is that you just continue to pay the minimums and always be in debt. There's going to be some people that watch this video and think, well, you know what, that's great and all, but I'm just going to go ahead and keep paying the minimums or just keep having revolving debt on my card. But now if you want to actually pay off your credit cards by focusing on your financial future, that there is going to leap you forward in your personal finances and make things better for your future. It might not be immediate, it might not be a month from now, but it can be down the road. Now, if you chose option 2, I want you to click on the next video to learn how to best start paying off your debt today, so that way you can have a financial future that you are excited about. Now, if you made it this far into the video, make sure you hit subscribe today, and I'll see you guys in the next episode.